What if your crypto could earn money while you sleep? The average savings account pays less than 1% interest, but some crypto strategies are generating over 100 times that much. Today, I'm revealing the top passive income methods in cryptocurrency. These aren't get-rich-quick schemes. They're legitimate strategies used by both beginners and experts. Stay until the end for the highest yield strategy most YouTube videos never mention. This method has produced returns exceeding 20% annually with minimal time commitment. Let's discover how your crypto can start working for you 24/7. Why crypto passive income? Traditional passive income requires massive capital. Rental properties need six-figure down payments. Dividend stocks yield just 2 to 4% annually. Starting a business demands thousands of hours before becoming truly passive. Crypto breaks these barriers. You can start with as little as $100. Many strategies take under an hour to set up. Yields range from 3 to 20% or more annually, depending on your risk tolerance. The key difference is that crypto passive income doesn't rely on middlemen. Banks take depositor money, lend it out at 8%, and pay you 0.5%. Crypto cuts out these intermediaries, allowing you to capture more of the value your capital creates. But higher rewards come with higher risks. We'll cover both the potential returns and the dangers of each strategy so you can make informed decisions. Let's start with the simplest method and progressively explore more advanced strategies. Strategy 1. Staking. Staking is like earning interest for helping secure a cryptocurrency network. It's the easiest way to generate passive income with crypto. How it works. When you stake cryptocurrencies like Ethereum, Cardano, or Solana, you're essentially locking up your coins to support the network's operations. In return, you earn rewards that are automatically added to your holdings. The process is incredibly simple. Most major exchanges like Coinbase, Binance, or Kraken offer staking directly on their platforms. You simply hold your coins there and enable staking with a few clicks. Alternatively, you can use official wallets like Daedalus for Cardano or Phantom for Solana. Current yield rates vary by cryptocurrency. Ethereum, ETH, 3 to 5% annually. Cardano, ADA, 4 to 6% annually. Solana, SOL, 5 to 7% annually. Polkadot, DOT, 10 to 14% annually. The risk level is relatively low compared to other crypto strategies. Your main risks are price volatility of the underlying asset, potential slashing penalties if your validator misbehaves, rare for average users, lock-up periods that prevent immediate access to your funds. For beginners, I recommend starting with cryptocurrency staking through a major exchange. It requires minimal technical knowledge and provides a steady stream of additional coins with very little maintenance. Strategy 2. Lending. Cryptocurrency lending lets you earn interest by loaning your digital assets to borrowers. Think of it like being the bank rather than the bank's customer. How it works. You deposit your cryptocurrency into a lending platform. The platform lends these assets to borrowers who pay interest. This interest is shared between you and the platform. There are two main approaches to crypto lending. Centralized lending platforms like BlockFi, Celsius, or Nexo work similar to banks. You deposit your crypto and they handle everything else. Current rates range from 4 to 8% for stablecoins and 1 to 5% for Bitcoin and Ethereum. Decentralized lending protocols like Aave or Compound operate without intermediaries. Interest rates are determined algorithmically based on supply and demand. Current yields on stablecoins range from 3 to 10%, while major cryptocurrencies offer 0.5 to 3%. The risk level is medium. Centralized platforms may face regulatory challenges or insolvency, as we saw with Celsius in 2022. Decentralized protocols carry smart contract risks and liquidation risks for borrowers, though lenders are generally better protected. For most users, I recommend allocating only a portion of your portfolio to lending and diversifying across multiple platforms. Stablecoins generally offer the best risk-adjusted returns in lending markets. Strategy 3. Liquidity. Providing liquidity. Providing involves supplying your cryptocurrency to decentralized exchanges' DEX so others can trade. In return, you earn a portion of the trading fees. How it works. You deposit equal values of two cryptocurrencies, like ETH and USDC, into a liquidity pool on platforms like Uniswap, PancakeSwap, or Curve. Traders use these pools to swap between cryptocurrencies, paying fees that go to liquidity providers. Setting up requires more technical knowledge than staking or lending. You'll need a self-custody wallet like MetaMask and enough knowledge to connect to decentralized finance, DeFi, applications. Current yields vary dramatically. Stable pairs, USDC USDT, 5 to 15% annually. Mainstream pairs, ETH USDC, 10 to 30% annually. Exotic pairs, 30 to 100%, plus with much higher risk. Many protocols also distribute governance tokens on top of trading fees, potentially increasing returns. The risk level is medium to high. Besides price volatility, liquidity providers face impermanent loss, potential underperformance compared to simply holding the assets when prices diverge significantly. Smart contract risks also exist. For those ready to learn DeFi basics, I recommend starting with stable pairs that minimize impermanent loss. Only graduate to more volatile pairs after understanding the mechanics thoroughly.